Thank you very much, Director Hay, for coming down from Shenzhen to join us here today. Progress does not happen without some bumps on the road, whether you are crafting a new technology or new regulations to deal with the forward march of innovation. We are now going to welcome the woman who is at the helm of the organization that is responsible for meeting the challenge of new technologies to allow finance to flourish while also protecting investors. She is Ms. Julia Leung, the Chief Executive Officer of the Hong Kong Securities and Futures Commissions, and she is joined today by Mr. Christopher Woolard, a partner at EY. Ladies and gentlemen, please welcome Julia and Chris to the stage.
Hello, everyone. Julia, we've been given the task of trying to think about developments in technology and regulation in 15 minutes. You and I have sort of spoken about this, I think, for about the last 10 years. So we're going to have to really sort of compress ourselves. And I was only going to talk about two subjects that we know all the market is talking about, really. So tokenization and then AI, and how do you think about those from a regulatory perspective? So if we start with tokenization, I mean, there are some developments here, obviously, in Hong Kong that I think it'd be great just to be able to talk a bit about, but also what's the SFC's stance? How are you thinking about this? How are you thinking about the opportunities, but also how you manage some of the risks?
Like 3 years ago, the concern among TradFi and that DLT would actually dominate and also upend the entire industry with their technology. And stablecoin is going to undermine the function of fiat currency as a media of transaction. Now, the views now is more realistic. This is not going to be revolutionary. It would just be evolutionary as the Web3 ecosystem needs time to build up. But this is definitely coming. As you've heard Eddie and you've heard Secretary Hui, we've seen quite a lot of real use cases of tokenization already. A Chinese bank has issued digital structured notes. A licensed SFC licensed asset manager has issued funds, a private fund which is invested in real estate property in Hong Kong. You will hear more about it in the next few days. There will be more to come. Now, tokenization of a fund or a bond, it doesn't change itself. It's just a technology wrap around funds and bonds. It doesn't change the nature that this is security. And as securities, it will be regulated as such in its primary issuance as well as the secondary market trading. But we do, as a regulator, see potential benefits of tokenization, in particular in increasing the efficiency throughout the product life cycle, which is from issuance to clearing and settlement to transfers, and potentially to the point about inclusive finance, lower the cost of transaction. Now, while we are supportive of the industry, experimenting, making more of these use cases, we also see new risks associated with it in the innovative technology, particularly in the transfer and the ownership and the record keeping of these tokens. Now, later today, we'll be issuing a circular, two circulars, in fact, one on the identifying the risks with this new technology, and also what we expect from regulators, what regulators expect from intermediaries when they are doing the due diligence, doing their transfer or primary issuance of it. We also have another circular that is, if you're thinking of issuing a authorized funds, that is public funds, there will be additional safeguards or the expectations that we have on it. It is all about making sure that the assets are being safely custodied, transferred, and the ownership records are there, because this is, after all, a new technology.
Yeah, and I mean, that's obviously going to be, a pretty big development. In terms of some of the things you already allow. So, you allow an SFC regulated intermediary to offer virtual asset services to a retail investor. Now, that's not a balance that we've seen necessarily in other parts of the world. So talk us through, how did you get comfortable with that? And in particular, having to strike that balance regulators always have to between public protection, but then also allowing access to the wider market.
Now, our philosophy and our approach is always about investor protection. Now, we get comfortable with retail access to tokenized products or tokens themselves only when the technology is stable, only when the risks associated with these activities can be mitigated and in some cases compensated, and the ecosystem has to be more mature and developed, and most importantly, that we as a regulator can put a regulatory hook on the intermediaries interfacing with the investing public. Now, our regulatory journey started like 6 or 7 years ago, around 2016 or 17, when none of the above existed, all matured enough. So I take an example like the Big Four. If I ask EY, for example, whether you would verify the existence of the token itself, I think they took them some time in order to work out the procedures and process and due diligence in order to verify the mere existence. So, but then we noticed that quite a lot of other places would jump on the fray, fearing of missing out on the crypto boom. So we bucked the trend and only allow professional investors in this space for trading in crypto tokens or crypto products, probably only the jurisdiction to set such a high bar for retail assets. Now in 2022, that is last year, we allow retail access to certain products. Now, if you look carefully at what we allow, it's ETF traded in US conventional exchanges with VA futures underlying. So basically, it's cash settled. Basically, it's trading on traditional exchanges. And so it is with intermediaries, which are regulated by us through them, they can execute the trade or provide that kind of access. And we ourselves, a year ago in October, we actually authorized the first ETFs with VA futures underlying. So currently we have 3. Now, same time last year, FTX collapsed. So we plowed ahead with a new VATP licensing regime that makes it mandatory for those VA platforms to get licensed with us. And we also allow retail access for the first time to trade in our licensed platform starting in June of this year. Now, this is also a time when many jurisdictions kind of pull back and put on, because they had pretty light touch approach. We already have the safeguards which are good enough for retail. And then we put on more additional safeguards. For example, when you onboard a client, you have to do suitability, you have to assess their risk appetite and put on position limits. You have to have a crypto emittance governance framework to emit and only emit those large and with large market cap tokens. So all this, that's why we are comfortable to allow trading, which is currently going on now.
And I suppose just one last thing on tokenization. I mean, we know from certainly talking to our clients globally, there's still quite a lot of the story to come. There's still going to be quite a lot of developments in this space. So, I mean, can you just give us a simple version of what your attitude is towards how you're going to engage with the sort of the development of tokenization and sort of, Web 3.0 more generally?
We think that development and regulation go hand in hand, particularly in this space. You find that traditional finance, they operate on a traditional operating system. And then the virtual assets with the gamification, they operate on different operating system. They don't seem to meet. So with regulation, we can tell the traditional finance where the red lines are, and through this they are able to actually try and pilot with the virtual assets. And it is only when the TradFi and the DeFi and the new world, the FinTech startup, when they meet, can we actually build an ecosystem which would allow a greater use of and also more inclusive transparency in all the good things that come with, is potentially that come with the use of DLT in financial. Now, when TradFi, the reason why it's important to get TradFi into the space is that because when they come in, the demand for institutional grade custody, institutional assurance standards like smart contract audit, they will all come in because that's where regulators and institutional clients would be comfortable. If you don't have those ecosystem, those assurance, those audits, they won't come in. So that's what is happening. So until now, I take an example. Until now, we basically said intermediaries, to tell the intermediaries who are dealing on behalf of their retail clients that when they deal through the licensed trading platform, their customers can only deposit cash to buy those tokens. And when those tokens are actually liquidated or sold, they could only take back the cash, which is a kind of restriction because if I'm sure the clients would like to hold on to the tokens through the e-wallet. But in so doing is because the intermediaries do not have to deal with, those intermediaries are traditional finance, traditional brokers or traditional banks. So they don't have to have a custodian arrangements for those assets. Now, if those of you who've been following our circular, the joint circular that we issue with the HKMA, 2 weeks ago, we updated the requirements which allow crypto in and crypto out. That is, clients can bring crypto in, and when they bought their crypto, they can also take it out, provided that the cryptos are custodied with SFC license platform or in a bank authorized by HKMA. And HKMA will provide guidance to banks when they're operating a custody system. Now, custodian system is a key part of infrastructure. And another key piece in this will be stable coin as a means of payment in real world economy. And the HKMA was also concluding on that on top of what Eddie just said about the CBDC. So you see a pattern here. We take a building block approach in encouraging the development of the ecosystem for Web3. So it's one that's led by the industry. That is, only you can know what is in demand and what the customer wants and whether they want that customer experience. And when you come to us, our FinTech team and our SFC, then we look into the innovative technology or their business proposal, and we identify risk, and we see that, and we'll provide very clear guidelines on the expectations when you are dealing with it.
Very good. Now, at the start, we said time was never going to be our friend, and it's not. But I wanted to put one last question to you. So, enormous amount of interest around AI, particularly generative AI. Now, to some extent, not a new issue. I mean, we've had very large models and systems being used for many years, but this latest wave promises, power and strength in a way that we haven't really sort of encountered before. Lots and lots of global interest. The US and UK saying more about how they think about regulation this week. What's the SFC's view? And I know it's a bit unfair because I'm asking you to do a huge topic in like 2 minutes, but it'd be great just to get that sort of sense of approach.
There are two aspects to this question. As a regulator, we are very, very excited about AI, and we established a data analytics group within the SFC a few years back to explore the use of machine learning and AI in our surveillance, which is important, in our investigation, and also into different areas of operation to improve, and it has improved productivity and efficiency. Now, with the arrival of generative AI, we are also assessing the use of it in our operation and leverage on this technology. But we are considering the use cases very carefully because we're well aware that there are things like hallucination risks, which is that they give you very convincing response to your questions, but then it's not clear whether but they're obviously wrong sometimes. Second aspect, which is more of interest to the industry, is what our regulatory expectations are for licensed firms' use of AI. Now, the use of non-generative traditional AI and machine learning, as you say, has been for at least a decade now, and they're usually used in the hedge funds' portfolio construction, in trade execution and post-trade surveillance. Now, we already have quite a number of internal controls and risk management guidance around governance, accountability, transparency, which include, for example, when you are using AI, we will still hold the senior manager of the firm responsible. So we're not going to arrest the AI itself. You're just going to pursue the senior manager to make sure that they can explain, they understand, and they have competent staff, and they do thorough back testing to make sure that they deploy it appropriately. Now, and of course, the quality of data issue and mitigation of biases, these are all part and parcel of existing model risk management framework. Now, all the above actually apply to generative AI, and we expect that to be so. But I think one of the things that generative AI's big difference is the uncanny ability to produce responses to questions which are indistinguishable from a human being. So you're very easily led to believe that what they say is right, is true. So I think it is neat, and we have noticed that trading firms are actually take a very cautious approach right now in exploring how to integrate generative AI into their trading business. But we noticed that it's very popular with wealth management and with with retail brokers because they're considering the use of these AI chatbots for customer engagement. Now we actually think that it's time to remind our licensed corporation their obligations of their risk management measures, which in particular in high risk cases to consider whether humans should be included in the loop, so that you can always have, so that these things are not automatically going to the customers. Now, at the macro level, G7, G20, they are all talking about the concern is for concentration, because there's a concentration of the service providers, a concentration of these cloud computing, and also if all the firms, and many firms are using the same model, that might be exacerbate the herding behavior that we already see in the increasingly volatile market. Now, I just came back from an IOSCO board meeting, and there was serious discussions about that. But at the micro level, at least what we can do in our licensed corporation and financial institution is to remind them that there should be alternatives, that you should not be over-reliant on one model. There should be alternatives, and there should be contingency planning and risk management. Thank you.
That's great. I'm afraid we're out of time, but that was a really interesting, quick run around, I think, some of the key issues that are absolutely out there in the market, and from the regulator's perspective, you've got to try and set some frameworks for. So thank you very much, Julia, for sharing your thoughts.
Yeah, thank you.
Thanks.